Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. They were counting on catching you off guard, to launch their attack under the cover of darkness so that in the morning, when you groggily checked your phone, your only emotion would be fear. So that seeing the sharp drop in the silver price, you would think the party was over and panic sell your position. That was their plan. But this time, something went wrong. At first glance, it looked like a chaotic sell-off, but when I examined the details, I realized I wasn't seeing the footprints of market panic. I was seeing the evidence of a coordinated attack. It looked like a meticulously cleaned-up crime scene. And like any investigator, I started asking questions. Why at night? Why on a Friday?
You're on New Era Economics,
the channel where we decode the historical blueprints that govern the economy. Today, we are conducting a full forensic post-mortem on what just happened in the silver market. I will show you what traders call margin nuke. I will expose the historical playbook they are using, word for word, from the crash of 2011. Subscribe to learn more. Our investigation is just getting started, and most importantly, I will prove to you that this attack has failed. That the smart money didn't sell this dip, they swallowed it whole. The banks fired their silver bullet, but the monster of physical demand is still standing. And this is possibly the most powerful bullish signal I have ever seen. Get ready, the investigation begins now. So, we're at the crime scene. To understand what exactly happened, we need to examine the weapon that was used. Traders call it a margin nuke, and it is perhaps the most powerful and ruthless tool in the arsenal of exchange regulators. To understand how it works, imagine not a market, but a giant casino. This is the COMEX exchange. Most of the players here are not industrial companies that need the metal, but speculators, betting on the price going up or down. And in this casino, they are given an incredible superpower: leverage. It works like this. To place a bet on 5,000 ounces of silver worth, let's say, $300,000, a speculator doesn't need to have the full $300,000. They only need to post a small security deposit, or margin, of perhaps $15,000. That's roughly 20-to-1 leverage. It allows them to control massive amounts of metal with only a fraction of its value in cash. It is this leverage that allows the price to fly up so quickly. Speculators, seeing a trend, can place huge bets, accelerating the market. But this superpower has an Achilles heel. The security deposit they post is not fixed. Its size is determined by the owner of the casino, the exchange, and they can change it at any moment without warning. This lever is the margin nuke. And that is what happened last night. The exchange, seeing the price of silver getting out of control, hit the red button. They issued a notice sharply increasing the margin requirements. Let's imagine. Yesterday, to hold his position, a speculator needed to have $15,000 on account. Then today, at 2 a.m., the exchange tells him, "Your deposit must now be $22,000. You have 1 hour to find and deposit another $7,000, or we will forcibly close your position." Where do you get $7,000 at 2 in the morning? If you have one position, maybe it's possible. But what if you're a hedge fund holding 1,000 contracts? You need to find $7 million in an hour. It's impossible. And that's when the forced liquidation happens. The exchange's computer automatically puts that speculator's contracts up for sale at any market price to cover the difference. This is not because the speculator decided to sell. It's not because the fundamentals changed. It's because the owner of the casino changed the rules in the middle of the game. This first wave of forced selling pushes the price down. The price drop then triggers the stop losses of other players, creating a second wave. Others, seeing the fall, begin to panic and sell manually, creating a third wave. This is not a free market. This is a controlled demolition, designed to flush out everyone who was betting on a price increase using leverage. It is a weapon of desperation that the house uses when it feels it is losing control of the game. And the very fact that they had to use it tells us everything. The very fact that they had to use the margin nuke speaks volumes. But to understand the true motives and expectations of those who pushed that button, I realized I had to look into the archives. I had to study their past cases. And my investigation led me to two key historical precedents, two instances where this weapon was deployed with devastating effectiveness.
The first case is a genre classic: the destruction of the Hunt brothers in 1980.
As we've discussed in past investigations, the Hunt brothers saw the fundamental weakness of the dollar and began buying up physical silver and futures. By January 1980, the price had soared to nearly $50, and they were on the verge of breaking the entire paper money system. The exchange was in a panic, and that's when they deployed the margin nuke in its most brutal form. They didn't just raise margins. They introduced Silver Rule 7, which permitted liquidation only. And then, on top of that, they hiked margin requirements multiple times. It was a coordinated strike that forced the heavily leveraged brothers into bankruptcy in a matter of days. The lesson the system learned then was that the margin nuke is the perfect tool to eliminate any threat from the bulls.
But the second case is far more relevant to today. It is the case of the 2011 rally assassination. Many of you will remember it. After the 2008 financial crisis and the start of quantitative easing, investors around the world rushed into silver, fleeing currency debasement. The price of silver went on a parabolic run, nearly touching its all-time high of $50. Euphoria was everywhere. Everyone was certain the price would break $50 and head for $100. And then they struck. But this time they acted with more subtlety and cunning. Under the cover of a chaotic news cycle, the CME Group announced the first margin hike. On Monday, the price of silver collapsed by 10%. The next day, they raised margins again. On Wednesday, again. In just 9 days, they raised margins 5 times, increasing the cost of holding a position by 84%. It was like a slow strangulation. Every day, speculators who were betting on the price to rise were forced to sell to cover the new requirements. This triggered a cascade of panic selling. In 1 week, the price of silver crashed by 30%. The rally was assassinated, the bulls were slaughtered, and the silver market entered a multi-year bear market slumber. It is the repetition of this very scenario that they were counting on last night. They were relying on your muscle memory. They wanted you, seeing the news of a margin hike, to remember the pain of 2011 and think, the party is over. I need to sell before it's too late. They weaponized your psychological trauma against you. But, as we will see, they made one catastrophic miscalculation. They thought they were playing the same game as in 2011. They were wrong. They executed their playbook perfectly. They chose the right time, used a proven weapon, and expected a predictable result: panic and a crash. But the crash didn't happen. The price of silver stumbled, but it did not fall. This led me to the central question of my investigation. Why? Why did the very thing that worked flawlessly in 1980 and 2011 fail this time? My analysis shows that the reason lies in two fundamental changes that the perpetrators either failed to notice or chose to ignore. The first and most important piece of evidence is a complete change in the cast of characters. In 2011, the rally was largely speculative. It was driven by hedge funds, day traders, all those who were buying paper silver, futures, options, ETF shares, with massive leverage. They were the weak hands. They were vulnerable to a margin nuke because their positions were built on borrowed money. When the cost of holding those positions suddenly skyrocketed,
They were forced to sell.
Today's market is a completely different universe. Studying capital flow data, I saw that the primary buyers of silver in 2025 are not speculators. They are the strong hands. They are industrial giants like Tesla, Samsung, and the solar panel manufacturers. They are the sovereign wealth funds and central banks of emerging nations. They are millions of ordinary people around the world buying physical coins and bars. And here is the key. They do not use leverage. They pay in cash. When Apple buys tons of silver for its iPhones, they don't take out a 20-to-1 leveraged futures contract. They pay the full price. When an investor in India buys a physical bar, they do not care what the margin requirements are on an exchange in New York. A margin hike on the COMEX has zero effect on these players. They cannot be force liquidated. The margin nuke is a weapon designed to fight paper speculators. But today, the battlefield is dominated by an army of physical buyers, and the weapon simply has no effect on them. The second piece of evidence, no less important, is the state of the arsenal. In 2011, when the exchange suppressed the price, they had a nearly infinite supply of bullets. The COMEX and LBMA vaults were full of physical metal. Any surge in demand could easily be met by dumping a few million ounces of real silver onto the market, which reinforced the power of the paper system. Today, the situation is the polar opposite. As we've established in our previous investigations, the vaults are dangerously empty. We are in the 5th year of a structural deficit. Inventories have plummeted by over 70% in the last few years. They simply no longer have the physical backstop to support their paper attacks. They can push the red button, raise the margins, create a wave of paper selling. But it doesn't create a single new ounce of real silver. It doesn't help Samsung build a factory. It doesn't put metal back into the vaults in London. The margin nuke is a paper weapon for a paper fight. But we are no longer in a paper fight. We are in a physical one. And you cannot defeat a real-world deficit with paper regulations. This is why the attack failed. The perpetrator showed up to a gunfight with their old, trusted pistol, failing to notice that their opponent is now wearing a bulletproof vest made of pure physical demand. And the fact that the market absorbed this blow is the loudest signal yet that the power in this market has shifted from the paper manipulators to the real-world consumers and owners of the metal. So, the attack failed. But my investigation didn't end there. Analyzing the volume and order flow data during the price drop, I discovered something even more astonishing. The attack didn't just fail. It backfired spectacularly. It inadvertently created what traders call a picture-perfect bear trap. What is a bear trap? It's a technical pattern where the price of an asset is artificially pushed down to trick traders into selling, only to then aggressively reverse to the upside, trapping everyone who sold at a loss. Think about the psychology of the average trader this morning. He sees the news. Exchange raises margins. He sees the price dip below, say, $64. He remembers 2011 and thinks, the top is in. The government is stepping in. I'd better sell now and maybe even short the market to make money on the way down. And so our trader sells his paper silver. He might even place a bet that the price will fall to $50. But here is the key question of my investigation. Who was on the other side of that trade? Who bought what he panic sold at $63.80? Was it another retail trader? No. Retail traders panic on red days. It wasn't them. It was the whales. It was the algorithms of industrial giants. It was the sovereign wealth funds. They were sitting there with their limit buy orders, just waiting. They knew the margin nuke would shake all the weak hands out of the tree, and they were standing underneath with a giant bucket to catch the cheap shares that fell. Instead of triggering a cascading sell-off,
The margin nuke triggered a massive transfer of ownership. Silver moved from the hands of short-term, frightened speculators into the hands of long-term, fundamentally driven buyers. This creates a springboard effect. The market has now been cleansed of the weak, leveraged players. The ownership has transferred from paper hands to diamond hands. The people holding silver tonight are not the people who panic over a margin hike. They are the people who are holding for the long term, who understand its fundamental value. This makes the price floor rock solid. And what happens to our trader who went short when the price turns around on Monday? When it gaps up to $65, he is trapped. He will have to buy back his short position at a loss. His buying to cover the short will add fuel to the fire, pushing the price even higher. The margin nuke didn't kill the rally. It reloaded the cannon. It cleared out the speculative leverage so the next leg up can be healthy and sustainable. We are building a base at these levels, and a base built on physical demand is infinitely stronger than a spike built on paper speculation. The perpetrators didn't just fail to kill their victim, they accidentally made it stronger. So the margin nuke, their most powerful paper weapon, has failed. What's next? What is the next move in the playbook when the perpetrator realizes they are losing control? My investigation shows that we are now entering the most dangerous and most important phase, which I call the Great Decoupling. This is the moment when the two markets we discussed at the beginning, the world of physical reality and the world of paper promises, stop even pretending to be connected to each other. Their prices diverge.
Think about it. If raising margins can no longer suppress the price, what tools do the regulators have left? Their arsenal is nearly empty. They have only two nuclear options remaining, and both lead to the same endgame. Option number 1. Position limits. They can announce that no single entity can hold more than a certain number of contracts. This will be framed as a measure against evil speculators, but the real target will be the ETFs and large funds that are accumulating the metal. They will be forced to sell down their positions. This will cause a temporary drop in the paper price. Option number 2. Liquidation-only mode. This is their final argument. They can declare that for, say, the next 30 days, buying new futures contracts is forbidden. You can only sell. This effectively turns off the buy button on the exchange. If no one can buy, the price can only go down or sideways. In either case, the result in the paper market will be the same. The price on your phone's screen will plummet. It might fall to $50 or even $40, and those who don't understand what's happening will panic sell. But this is where the great decoupling begins. The buyers won't disappear. They will simply leave the exchange that has banned them from buying. The industrial giant that needs silver for its factory won't say, "Oh well, the COMEX is closed, let's halt production." No. It will go to other markets. To the Shanghai Gold Exchange. To the London over-the-counter market. It will go directly to physical dealers. And what will happen? We will see two different worlds. In one, on the COMEX screen, the price of paper silver will be $40, because no one is allowed to buy it there. And in the other, in the real world, the price of a physical coin or bar will be $90, because everyone is desperately trying to get it. The gap, or spread, between the paper and physical price will be $50. This is the collapse of the COMEX as a price discovery mechanism. If the exchange price is $40 and the real price is $90, no silver producer, no mine, will sell their metal to the COMEX. Why would they? They will sell it to Shanghai for $90. The COMEX vaults, already nearly empty, will drain to absolute zero in a matter of weeks. The exchange will become a zombie market, trading paper ghosts with no real metal behind them. The regulators are trapped. If they do nothing, the price of silver goes to $100 due to the physical deficit. If they intervene too heavy-handedly, they destroy their own casino,
and lose control of the global price forever, ceding it to the East. They are damned if they do, and damned if they don't. This is why last night's failed attack is so critical. It proved that they are losing the ability to influence the market without blowing up the entire system. They are on the verge of losing control. And the great decoupling is the next logical step in this process. So, let's return to our crime scene. The red candle on the morning chart. What looked like an attack was, in fact, a self-exposure. The margin nuke was the last shot fired in the paper fight. But the fight has already moved into the physical realm. And that shot was a blank. Our investigation has shown that last night's events were not just another bout of volatility. This was a historical signal. A signal that the suppression mechanism that has worked for decades has cracked. The power in the silver market is shifting from those who print promises to those who hold the real metal. Why are you holding silver? Are you holding it to make more dollars? Or are you holding it because you understand that the dollar itself is broken? Everything we saw today, the manipulation, the margin hikes, the volatility, it's all just noise. It's the sound of a dying system thrashing around. The physical reality remains unchanged.
Number 1. Geology.
We cannot mine more silver. The Earth's reserves are depleting. Number 2. Technology. We cannot build our green and digital future without it. And number 3. Mathematics. The global financial system is insolvent. They have to print. When you hold physical silver in your hand, you hold a claim on the resources of planet Earth. When you hold a paper contract, you hold a claim on a bankrupt bank. The events of the last 24 hours are proof that the paper system is detaching from reality. The paper system is trying to tell you, silver is risky, sell. The physical reality is saying, silver is essential, buy. You have to decide which reality you live in.
The failed attack was a test.
It was a test of your conviction. Did you panic? Did you sell? Or did you look at the price drop and smile, knowing that it's just a discount on real money? The banks are betting that you are weak, that you are impatient, that you will trade your hard asset for their paper promises. Do not give them the satisfaction. The game has changed. The old rules, where they could crash the price at will, are gone. The new rule is physical scarcity. And in a world of scarcity, he who holds the metal makes the rules.